Welcome to this episode of Dollars and Cents. Today we're diving into the fascinating world of investing biases, the hidden forces that shape our financial decisions. Whether you're a seasoned investor or just getting started, understanding these biases can help you make smarter, more rational investment choices. Let's jump right in with our first bias. Have you ever noticed that when you believe in a stock, you only read news that supports your opinion? That's confirmation bias, seeking out information that agrees with our pre-existing beliefs while ignoring anything contradictory. Imagine you invest in a new tech startup because you believe it has revolutionary potential. Instead of objectively evaluating both positive and negative news, you only follow analysts who predict the stock will skyrocket, dismissing warnings about high debt levels or management issues. This can lead to poor investment decisions based on incomplete information. Speaking of overconfidence, this next bias is all about thinking we know more than we actually do. Many investors believe they can predict the market better than others, but statistics show that frequent traders, often driven by overconfidence, tend to underperform the market over time. An investor who made a few successful stock picks starts to believe they have a golden touch and ignore the need for diversification. They concentrate all their money into a single stock, only to see it crash unexpectedly, wiping out their gains. Did you know that we feel the pain of losing money twice as strongly as the joy of gaining it? That's loss aversion, and it explains why investors hold onto losing stocks for too long, hoping they'll bounce back. Example: suppose you buy a stock at $100 and it drops to $70. Instead of selling and reinvesting in a stronger opportunity, you hold onto it indefinitely, hoping it will recover, even when signs point to continued decline. This can result in missed opportunities for better investments. Anchoring bias occurs when we fixate on a specific price point, often the price we paid for an investment. If you bought a stock at $50, you might refuse to sell at $40, even if the company's fundamentals have worsened. An investor purchases a stock at $200 per share. Despite deteriorating financial reports and an overall industry downturn, they refuse to sell below $200, believing anything less would be a loss. However, by holding on too long, they watch it drop further to $120, missing the chance to cut losses early. Ever felt the urge to buy a stock just because everyone else is? That's herd mentality. Whether it's meme stocks or the latest tech craze, blindly following the crowd can be risky. In early 2021, GameStop stock surged as retail investors, influenced by online communities, rushed to buy. Many investors jumped in at its peak, hoping for continued gains. However, when the hype faded, the stock plummeted, leaving many with massive losses. Now, let's take a break, and when we return, we'll dive into 5 more biases that can trip up even the savviest investors. Stay tuned.